Okay, we're in Unit 5.2, titled Contingent Liabilities. What is a contingent liability? It is a potential yet unknown cost that may or may not incur. So, what are they? Well, first of all, very important, and you may see this again, there's three categories of contingent liabilities. The first is what's called high probability. High probability is where the costs can be estimated. However, a loss must be disclosed in the statements. There's an example, property. Who would buy property and not disclose it, especially if they took a loss? You have to, especially if there's an audit. Now we have medium probability. Medium probability is comprised of costs, again, that must be disclosed in statements if the contingency is probable. And the key there is if. So we have an in-between factor there. It's not necessarily probable. However, it could be property. It doesn't have to be. It could be a small product as well. Now we have low probability. These costs must be disclosed in the statement if the contingency is probable, yet not necessarily the likelihood where the cost would be triggered. Most times, no reporting is required due to the low likelihood of that cost. Here's an important example. Your client sold a faulty product. They had significant warranty claims as a result. Not the best situation, especially if you're a business owner. Help me out. What do I do? Well, in this case, it's okay. It falls under low probability, even though it was a faulty product. If your client has isolated the bad product and actually performed what we know today as a recall, they could settle the related warranty claims outside of a legal circle or inside of a legal circle without much just cause. Still be safe. Chances, in this case, are low for dealing with similar warranty issues on the product in the future. And that is low probability, and that is the conclusion of 5.2.